Throughout this series, we've talked about something that initially sounds almost impossible, a zero federal income tax retirement. In the first video, I showed the tax code actually makes this mathematically possible under the right conditions. In the second video, my partner John explained how the bridge decade, the years between when you retire and when you start your Social Security, is potentially one of the most powerful opportunities to structure your retirement income efficiently. And in the third video, Mark walked through the hidden landmines that can kind of quietly derail a retirement strategy. Things like Social Security taxation, RMDs, required minimum distributions, and Medicare's IRMA calculations, how your premiums are calculated for Medicare. But now I feel like we should take a step back and clarify something important. Because the goal of this strategy is not actually to pay zero taxes for everyone. As I said previously, zero is simply the headline. The real goal is optimization. In certain situations, a household can structure their retirement income in a way that results in a zero federal income tax. So let's give an example. A couple could withdraw an amount from their traditional IRA equal to their standard deduction, then cover the rest of their spending from Roth IRA withdrawals, which will be invisible on their tax return. Those won't appear in their adjusted gross income, and the federal tax bill can be zero. It's a very desirable outcome for a lot of people we talk to. But this outcome does depend on those very specific set of conditions. You have to have sufficient Roth IRA assets in order to produce the income needed. You have to have limited taxable passive income from other sources, and then careful coordination of planning of your income. A lot of the households that we work with, especially some of the higher income ones, will have additional income like dividends, rental income, capital gains, business distributions, or maybe pension income. Those income streams are going to appear in adjusted gross income, regardless of where the spending comes from. So this can kind of thwart a zero federal income tax strategy. What this means is that a literal zero income tax outcome may not always be achievable, and it's perfectly okay. Because the real objective, as I said before, isn't zero. It's the lowest lifetime tax burden possible. This matters to you and to your heirs. So let's say a retiree does need that $125,000 per year. If all of that income comes from a traditional IRA, the federal tax bill is going to be roughly around $10,000, depending on deductions and brackets, of course. Over a 25-year retirement, that could be about $250,000 in federal income tax. But if that same household sequences the withdrawals intentionally, using the standard deduction, Roth IRA accounts, careful income planning, that number could fall dramatically, even all the way down to zero. If you reduce your effective tax rate from 22% down to around 10% over your entire retirement, that can represent hundreds of thousands, if not maybe even millions of dollars that stay with the family instead of being sent to the IRS. And that outcome can be just as meaningful as achieving zero for another type of client. So for decades, retirement planning focused on one primary idea. This is something that really frustrated me. Defer taxes as long as you can. Save into tax deferred accounts like your 401k. Let the money grow. Pay the taxes later. But the challenge with this is pure deferral strategy is that it often creates a future concentration of taxable income. We've seen it a lot. Large IRAs are going to grow. RMDs, required minimum distributions, are going to begin. Social Security starts, and suddenly you have multiple income streams stacking on top of each other. And the tax rate in your 70s and 80s can end up being a higher effective rate than when it was during your working years. That tax sequencing that we're talking about takes a completely different approach here. Instead of simply deferring your taxes indefinitely, it focuses on when the taxes are paid, how those incomes interact with one another. It's not just about avoiding taxes forever. It's about paying them at the most efficient time. That's all we're talking about here. The strategies that we've discussed in this series are not one-time decisions. They're going to require ongoing analysis, a lot of thought and planning. Investment returns are going to change. Account balances are going to change. Tax laws are going to change. This is my 26th year of doing this. They change almost every year. And thresholds like Social Security taxation or IRMA premiums will shift from year to year. And therefore, your strategy may have to shift as well. That's why this effective retirement tax planning typically is going to require some ongoing planning. You're not just deciding what to withdraw this year. You're evaluating how today's decisions affect the next 10, 15, or even 25 years of retirement income. The framework that we discussed today, it tends to work best for households who have accumulated a meaningful portion of their assets in retirement accounts, have at least some Roth assets or Roth conversion capacity. Maybe a Roth conversion is right for you, and have 10 to 15 year planning horizon before they're into early retirement. This strategy cannot usually be assembled in just a few final years. before leaving the workforce. It works best when it's built intentionally and over time. And when those elements aren't coordinated, unintended consequences can appear years later, which is why many retirees only discover these issues after their required minimum distributions begin. At that point, a lot of this may be too late. The ability to restructure the plan is going to be more limited. Listen, the idea of a zero tax income retirement may sound surprising at first, but the real insight behind this series is much simpler. Federal income tax in retirement is not fixed. It's influenced by where your income comes from, when withdrawals happen, and how the tax code interacts with those decisions. It's not a loophole. It's not a trick. It's a strategic design. And it's an ongoing design at that. And when the design is done well, the difference over a 25-year retirement can be very noteworthy and meaningful, not just to you, but also to your heirs. If you'd like to explore the full analysis behind the strategy, you can download the white paper linked below. If you'd like help in evaluating what's realistically achievable in your household, we invite you to schedule a conversation with our team, because when it comes to retirement taxes, the goal isn't just saving money, it's building a strategy that will work for decades and for your heirs for the rest of your life.